everybody. Thank you for joining us at the Regional Business Support Network at our monthly Biz Bite episode. I am Michelle McFadden, the Business Development Advisor, and I am super excited to talk about succession planning because I don't know about you, but I get a little older every day. So if that's you too, that means that we need to start, if we haven't already started, looking at how we get out of our businesses. I know it's pretty easy to get into business, but how do you get out successfully and profitably is also what we want to chat about today. So I will ask you to hold all questions until the end of our presentation, so we can give you as much information that we can in the 20 or 30 minutes that we have for our Biz Bite. So joining us today is a fantastic human. Oh my gosh, as soon as I met her, I loved her energy. Minetta McDonald is from Service Credit Union, Service Wealth Strategies. And when I saw her presentation on succession planning a few months ago, I said, Minetta, would you please come and present for my crew? So she is here today, and I'm super excited to hand the microphone over to you, Minetta, to introduce yourself and get our Biz Bite started today.
Okay, well, thank you, Michelle. I feel that you give me way too many compliments. A little background for myself is that I've been in the industry of finance for 22 years. And during those 22 years, I spent 16 of them at Sun Life. I was training and developing junior and senior advisors when it came to investment planning and insurance planning. But this one product that I'm actually going to be showing you today, none of them would ever jump on board with it. And it's not because it's a bad product, but it was because it's a very complicated product that takes a lot of time to be able to explain it to someone. But what I really liked about it is it's something that will cover off in so many different areas that we're going to discuss here. And that is succession planning. It is, estate shrinkage. It's all of these different things, but I'm probably just going to get right into that portion there. Now, since we have such a small group, I would really, really love it if there is a question along the way, because where this is, again, a bit more complicated, I want to make sure that I'm just completely covering off on what needs to be answered as it's being thought of. Does that make sense for everyone? Perfect. I'm going to take any no or any non-nods, and when you're not saying anything, I'm going to take it as I am very smart, very intelligent, and I have explained everything to you guys so well that you don't even need to respond to me.
You're doing so good, Minetta, already. So good. So now that we've gotten into our businesses, and we're getting to the point where of how do we get out? Do we sell? Do we pass it down as a legacy? Do we just close the doors and say goodbye? How do we process like the exit strategy from our business?
Awesome. Okay, so this one here is just going to not do something smart for me. Just a second. Technical difficulties already. Boom. Okay, so I just want to lower this down and get into this one. Come on. We just ran through this, Michelle and I. There we go. Okay. So with succession planning is the process of deciding how are you going to pass on or sell your business while making sure your future is financially secure. And then when we're looking at equally important for this is mitigating your estate shrinkage. Estate shrinkage, that's the amount of tax you're going to leave behind for your loved ones to take care of and send off to Ottawa for you. Estate equalization. Estate equalization is when you have, say, 3 children, one of them wants to be in the business and the other 2 want nothing to do with it. We want to make sure that we're able to supply, again, fair, not always being equal, but we want to make sure that the person with the sweat equity in there is able to afford to continue on with that business. And then we also want to make sure that there is some left behind for the people who do not want to get into the business. So they deserve some stuff. And then finally, for planning for your retirement. I'm sorry, very few people, when you're in a business, and I'm not even, it doesn't matter if it's a small business or if it's a farm, the individual in there, they're so busy inside their business trying to grow that thing, they continue to leave themselves out of the equation. So what is doing your best to have as little estate tax for your family as possible? And then keeping the business in your family, which is, again, I said fair is not equal. And you've worked hard. How are you funding your retirement? Then I like to know, how much are you wanting to send to Ottawa and how much do you want to keep? I should probably look into the crowd there. This is when you can really raise your hands. How many of you guys want to send as much as possible to Ottawa? Raise your hands. Good going. I knew I wouldn't see anything there. Okay. So what we're going to do is we're going to discuss a popular strategy that can be used for all of these. Mitigating the estate shrinkage, funding your retirement, funding the succession planning, and it's one product that can be designed to work for all of these. And when I say funding, there is succession planning. What we have to look at with that, it's really nice to turn over a business to, maybe it's the daughter or the son in the family or it's nephew or whatever that looks like. But what if they can't afford to keep that business going? If that is the case, we want to make sure we can fund that as well. So I'm going to start getting really funky here. So just a second, I'm going to pull a new slide up here. And it's not going to be that one. It's going to be this one. So with this, yes, it's an insurance policy. But if everybody in the room here, whoa, don't do this to me. If everybody in the room would stop and think for a few minutes, you've probably been hearing a few buzzwords out there. And the buzzwords that have been going around, and if you haven't heard them, please do look them up because it is something that has been talked about for quite some time. So this is what's called a participating insurance policy. And when it's referred to in the finance world, it's actually referred to insurance as an asset class. And the reason for that is this type of policy, it can be set up similar to a TFSA. So let's all realize that if the government CRA is getting involved with these, that must mean there is a benefit to you with them. And so what this is I choose whatever amount, this is just pulling out of the sky, but I just choose whatever amount is needed for the family or the person I'm dealing with, and I structure it for what their needs are. This person here, what I'm structuring this to look like is this is a 45-year-old person who says to me, okay, Minetta, I'm still going to need extra money during my working years so that if something were to happen with me, I want income replacement to happen so that my spouse can still continue on with the retirement plans that we have. I also want to make sure that there is a lifetime benefit sitting in there that it can eventually go to my estate and help with that estate shrinkage. Now, in order to do this, what we're looking at, so we normally, like when I'm doing a comparison, what I'll do is I'm looking at someone who oftentimes a person has a GIC set up, and the reason why they'll have a GIC set up is because they do not want to have that risk that can happen with putting it in the market, and they want to have that access. Each year when that rolls over, they want to know that where they're standing as far as cash flow in their business, anything along that lines. So that's why they use these things. So my examples here are going to be comparing this to that. So this person had 800,000 in a GIC. I took 450 of that and used it as an example as to what we could do with this type of product compared to the GIC. What does it mean? So it means I'm maxing out as much as I can in deposit that the CRA will allow. In this instance, the CRA will allow the 34,000 or 575,000.12 per year is allowed to go in and not be charged any tax on the earnings that are going in here. Then there's the cost of the insurance here. Over here, this is just saying a lifetime maximum amount that is allowed to be deposited into this plan to take advantage of the dividend rate is this amount here, 385,000, we'll call it 386. Now, what I wanted to let you know, the dividend rate that goes inside here is 6.35. And at a 6.35 tax-free dividend rate, this could be equal to you trying to get 8.2 to 8.4 outside in the market somewhere. So we both know, or we all know, I should say, we all know it's difficult to maintain that kind of an amount every single year for the lifetime of what you're looking for. So first and foremost, I will need a show of hands on this portion here. So are you understanding that I'm purchasing a $2 million policy in which I'm adding an extra million in there till the gentleman is 45 years old? And are you understanding that you are able, but not required to, add extra funds in here to take advantage of that dividend rate? And then that means that we're using an investment amount of $75,000 a year. Is everybody on board with that part? Perfect. Thank you. And the cup in the air is the same thing. I'll go with that one too. Okay. Thank you. Sorry, I'm a maritimer. As a maritimer, I shoot from the hip. I have a little bit bigger sense of humor than some people and a little bit larger than life personality. So you will have to forgive me. You will also notice, though, that I have learned over the years to slow down and not talk quite so fast. So you can actually understand me today, right? Okay, let's go further. So what I'm showing you here is what one of these policies would look like as I'm setting it up. Now, on this side here, we're going to disregard it. I will explain it. It's just what a standard policy would have looked like if we were not taking into account the dividends and the extra deposits. And it would be this gentleman would be paying $40,000 and $425 each year until he finished that year 20 and he got rid of that 1 million and he'd be down to this for the rest of his life. And that this is the insurance involved in that. And then there's some guaranteed cash values sitting in there. I'm focusing on this side. And the reason why this side is called non-guaranteed values is because of the current dividend scale. And anybody that has any knowledge of the investment world, you cannot guarantee a dividend, but Manulife I'm using here and Sun Life, neither of them have ever dropped below 5% dividends back to World War II. So if we're not seeing below 5% back to World War II, I'm pretty comfortable in saying, hey guys, these illustrations that I'm showing at 6.35, we have portions of it that'll show -1, which is 5.35. I'm pretty confident that I'm showing you something that should sustain itself going forward. Now, the dividends, as they're paid into this policy, what they are paid in based on is the premium cost, the amount of cash value sitting in there, and of course, the extra cash that's being put in there. So that extra cash being put in there increases this cash value, which is why the dividends, and it's like anything else, paying equity against your home early on will grow that, or paying money against your home will grow your equity quicker than it will doing that long period of time, all of this type of stuff. Same idea. So we're just trying to max out early on how much we're putting in there for that first 6 years. And what I'm saying with that dividend notionally, so it's not written here, but notionally what I'm saying, please, Mr. Dividend, will you drop into a spot and grow well enough so that my client does not have to pay any more year 7 and on for his policy or their policy? Will you also please grow my cash value in here because I have some tax strategies that I want my client to take advantage of. And then, of course, we want to make sure that the death benefit is growing as well. And everyone will notice something about these early on because a dividend that is being put in there is meant to be able to, you could take it in cash or you can leave it in here. And I'm saying leave it in here for the tax strategy purposes. Well, then if that person were to croak before they're supposed to, and before they got to take advantage of that extra cash that's building in there, you will notice that these, the death benefit will always be higher. And then it'll start dropping down as that policy starts paying for itself. Reminding you, and this is where it does get a little bit complicated, reminding you that this is a $3 million policy that will actually go down at age 66 to 2 million because we do not want the term. So realistically, when I'm looking at these numbers, they are not supposed to be any more than 2 million, but we're looking at 2,334,000. And then as we go along, you're seeing these increases yet again. By the time this person is sitting at age 85, they're 2.8 million, age 90, 3.1 million. So what that is all about is, again, this is all what these dividends will do. They will pay for the policy eventually. They will increase that death benefit. So then what I want to now talk to you about is tax strategies. So is everybody on board with what I have explained with this illustration as to what's happening here? Is everybody understanding the fact that this is not being paid for from continuing from year 7 and on? And is everybody understanding the rationale as to why this cash value continues to grow and that the death benefit is growing? Is everybody okay with that? A little raise of hands would be helpful. Perfect. Just sort of kind of thing there. I get it. I totally understand it, because the fact that it's notional makes it hard to see where these dollars are going in. But if we were to actually visually see this, we're looking at this cash over here. See how it's 2,195? That 2,195 is what every permanent policy says. I'm going to give you some cash. And this value that sits on this side, this set up for the person who says, okay, I'd love to have a policy. And then they come on hard times 10, 15 years in down the road, and they have guaranteed 15 years later, they have this 471,000 that they cancel the policy, they will get back. But what we're doing with this is, look here, we're adding in the dividend. So therefore that 2195 is actually now 38,408. That's how the dividend has affected. Does that help a little bit more? Perfect. And you know what? Anything that is not quite on board, you are going to have my contact information. Please do reach out to me, because one-on-ones are often a very good way to go through something like this. So now what I want to talk to you about. What I want to talk to you about is the tax strategies. So one of the things that we all know is that first and foremost, this death benefit in the beginning is, again, to help for mitigating if he were gone, that there would be a replacement of income in there. And then once we got past that zone, now we're looking at what we want to make sure that is there for the estate, so that we can pay out those 2 kids that do not want anything to do with their parents' business. Fair? Everybody's good? Cool. I saw those heads shake, not. But anyway, just teasing. Okay, so we do know what's going on there. But now when we're looking at this part in here, this is where there is an unbelievable opening. And this opening has been around more than 20 years. Top 5 banks have been working with this, and Manulife Bank and Equitable Bank have been working with this. So we all know that somebody looks at these kind of premiums and they say, oh my God, but Minetta, what if I came on hard times? I'm in year 4, and that year I cannot make that $75,000 payment. Well, what am I going to do, Minetta? And I'm going to sit back and say, fear not, my darling. I am going to find you a way. What we can do is any of the cash flow that is sitting inside this column here, these banks that I'm talking of, some of them will do 85% loan to value, some of them 90. What we're going to do is we're going to collateralize what's in here. So year 4, what you have in here is you actually have 183,000 of cash build up in there. You want to have $75,000 to go and pay for this year 5 premium. Well, maybe what you want to do is you want to get this off your back, and instead you want to have 150. what we would do in those situations is I would go and work with you to set up with one of the top 5 and also work with manual or equitable. I personally would likely work with manual because I have very good relationships with them and they do 90% loan to value. So what am I going to do? I'm going to get you your $150,000 back out of there. No, I should say, let's clarify this. I'm going to collateralize 150,000 because I want this to still have that compounding effect that it deserves to have. So all I'm wanting to do is make sure your last 2 payments, you have money for that. What am I going to do? We're going to get that loan out. Let's just say that loan is sitting at 6%. If that loan is sitting at 6%, you have the ability to write off that loan as long as you are trying to either expand your business or grow your funds. So what are you doing? You're going to take that $150,000 and you're going to bring it over to your investment advisor and you're going to say, please grow this for me. So that is going to satisfy CRA's want to make sure that you're growing this money. So now you're writing off that 7%. Well, how many here would have heard about and I'm going to be candid here, the idiot moves that were made years ago whenever people would pay off their mortgage and then all of a sudden they decided they're going to collateralize some equity in their home, bring it to the market and go out and see what they can do, right? There was a lot of those people lost their homes because they're doing this towards the market. The stupidest move, I'm sorry for being candid, that anybody could make because you're risking your home to do that. Well, over here, what are you risking? Over here, the way that this 150 would work is it never has to be paid off until the day you die. Not bad? Sounding like it's too good to be true? A little wink and a nod. Yes, I knew it. Okay, so that $150,000 is always going to be owed to the banking institution that it was borrowed from. Every single year, you're going to write off the cost of that loan at that 7%. And may I remind you, what you have taken out of here is 150, not taken out, my wording has to stay, what you've collateralized is $150,000 that cannot be taxed because there's no such thing as tax on a loan. So what have I done for you? I've actually gotten you even more than that 150 out for that because of the fact that you're not going to pay tax on it. But since you're not paying the tax on it, I do want you to pay the cost of that interest-only loan. So it'd be like a HELOC. Interest only set at 6%, you're going to do that. Your investment advisor, if they're not getting you 6%, there's something wrong. Should be a wash. Now, what if I could tell you, though, there is another write-off that can happen here? Now, I can see by the excitement on your faces, it's amazing. I can see that you just can't wait to see what I'm about to show you. Okay, so let's go down here. And I'm going to go into next and next. So in this screen here, well, I'm going to go backwards. In this screen here, this is what is called net cost of pure insurance. It's a number that the actuaries of an insurance company will come up with that says, okay, this is how much that insurance actually costs. And then there's a bit of mortality rate we're going to add into that as well. So what that means is, I told you, you're only paying that for the first 6 years. If you did this loan in year 5, you come out with a loan to pay for these next 2 years, you are now eligible to write off $4,885.80 against all incomes. Okay? Now, you are not paying for this in year 7. Do you think that you would be able to still write off if you're not paying for this policy, the net cost of pure insurance? Probably not, eh?
I know I love me some tax write-offs when it comes to business.
Hello? You can write off this to infinity and beyond. Because it doesn't matter that you took the time to pay off your equity or your pay this off early. This is still your equity that's in there. So year 7, you get this. And let's go to that guy at age 65. So he's a 40-year-old person. He's been writing off every year. Look, $28,000 he's writing off at age 65. At age 75, he's still writing off $37,000. These are his write-offs each and every year to infinity and beyond. Fair? Gotcha? Okay. So I want to see, and I don't remember your name, the gentleman with the orange container that just took a drink. Hi.
Steve,
I want to
think
make
she
sure.
called you out.
Right? So, did you catch on to this portion of it? Okay, perfect. Okay. So now, I'm going to recap. I'm going to go backwards here. And then what I want to do is I want to bring this illustration here up. So, what I want to recap is, it is an investment. It's not an insurance policy. When I'm teaching people, or what I should say, when I used to teach my advisors, I'd almost have that little, the little stick that the marm would have in the library when you were too noisy and slap you over your hands with that ruler. This is what I wanted to do with them when they said insurance. Yes, it has an insurance component, but what would you focus on in here? Would you focus on the investment side of this, or would you actually be looking at that insurance at the end? I'm sorry, I'm looking at tax write-offs, cash flow, everything like that. So what's that going to do for me? Well, it's going to do many things, because first and foremost, if I want to start my retirement funding, I can go and pull money out of this. I can start here with this person here. He wants to do something, let's just say at 52. At 52, he's got 321, so maybe we can take 300,000, collateralize that, and put it with an investment advisor. Now that's growing, so that by the time he turns 65, 14 years later, he's going to have a pretty good nest egg there. Plus, he's had his write-off again of the interest rate on that collateralized loan and his net cost of pure insurance. Now, that 400,000, God bless this poor man. At age 70, he croaked. What's going to happen? There's 2,365,000. We're just going to take 300,000 off of that. It pays out the loan, and the balance of 2,065,000 is going to the estate. Now let's add something else in, though. He took out the 300,000 when he was 52. They're 51, right? Well, look. He's getting down here. Look, at age 65, he's got 835. At age 70, he's sitting there with $1 million. Let's take that million, subtract 300 from it, because he's already collateralized 300. He's still sitting with 700,000 that he now could, if he wished, collateralize another 300, another 400, another 500, 90% loan to value. Bring it over, drop it in the hands of his investment advisor, and continue to grow. Now, when we're doing this, I'm talking about growing money for retirement, but there's also another way that you can write this off, and this is when you're expanding business. So let's take the succession planning idea. We've got the one kid that really wants to buy into the business. Well, could we set something up like this in their name so that they actually have this amount of money that's building up inside of here, so that when it comes time for them to go into the business, could they maybe use this money to buy the business? Make sense? Right? Okay. I'm gonna go a little bit further, because I don't want to just over, digest, or I want you guys to digest this, put it that way. I don't want to overdo this. Okay, so back into past there. So when you're looking at estate planning, when you're looking at succession planning, retirement planning, you need professionals involved. And that is the one thing that too many people do not take the time to actually do as well. Because again, I know you guys taking this half hour with me this morning is taking a lot out of your business day. And it has to be, I'm hopefully, and I will discuss that afterwards, that I'm going to give you a value add that made it worth your while to take that time out, because your every minute in your business is valuable. And if you're anything like myself, because I have been self-employed up until just the last 2 years. And even now I do a bit of a salary, which is I'll never survive on. I still have to work in my business to bring things in. So I was the person, I actually got to a certain point in my business at one point in time where I was working too long of hours. So my 12-hour days, I'd be doing 3 and 4 days in a row. And I had my office downtown. And I was one night leaving the office and going to my car. And I had to go into one of those parkades with this, the spiral staircase going down that was cement. I fell asleep. I just fell asleep and fell down. Thankfully, it was on one of these turns. But at the end of the day, it's not like I had narcolepsy or anything like that. It's just plain and simple exhaustion. So I understand what it is. I worked 40 days straight at one point in time. I was white knuckling it when the highway Deerfoot was shut down during a snowstorm. First time I've ever seen that. I'm white knuckling out to Okotoks from Calgary because guess what? That's my job. That's what I got to do. So this is where I'm saying that I understand everybody that is in business and what you're having to do to get through your business. But if you utilize someone like myself who maybe can introduce you to the people that you need to know to be able to help you. So what I've got here is estate planning services is a complimentary service that is offered through my company. My team will do it. Financial services, obviously, is your in-house banking and stuff like that, if that's ever needed, payroll, that kind of stuff. And then we're looking at service wealth strategies, which is my division. So what I am called is a wealth protection specialist because of the fact of me trying to find out whatever strategies I possibly can to save you as much money in your pocket or leave as much money to your family as we can, rather than sending it to Ottawa. They have enough of ours. Then we have the retirement planning in there. We have the insurance one. Now we get to the other professionals. We partner at Service. We partner in every small community. We partner with a law firm and we partner with an accounting firm. Because of our reputation, we also try to we do make sure that they are there to service the people that we put in front of them. Example being, we had a grand firm, I'm not mentioning names, but we had a wonderful firm in one of our smaller communities that was doing a great job, but they started getting too busy and the files started going behind. When that happened, we partnered with a second one because we're not wanting you to wait around your precious time any longer than you need to. Then we look here, business broker. Not enough people know about what a business broker is. When it comes to wanting to sell your business, I have a colleague that I've been working with for the last, about 5 years, 4 or 5 years, in which that when I know a company is looking like they want to sell, I'm going to introduce them to him. Why is this important? Well, if you are trying to sell your business and John Doe down the street finds out about that, the value of your business just dropped because they know you're trying to sell. So you're trying to keep that as quiet as possible until it comes to actually talking face to face with someone who is definitely interested in that. And this is where Paul comes in. So Paul will broker that. Paul has people, obviously, that are out there looking for businesses. He has ways of making sure others can get finance, because what he does, actually, he talks to me. But you know what I mean? There's just all of these different aspects. So this team right here, you need to have someone involved in that. And I'm going to speak to the accounting and legal side of things. I got to get rid of this. I'm going to speak to the accounting and legal side of things here too. I don't know how many people I know that have had an accountant and they've worked with that accountant for a lifetime. And they're fantastic. They worked with my dad. They worked with my mom. They worked with my sister. We trust them so much. Well, guess what? They're so bleeding busy. They don't have the time to go out and sit down and learn what Minetta is discussing about. So those are the types of people where we do need to educate them for one thing, which is good to set me in front of them. The secondary part of that is that you should always try to get a second opinion. You could be paying a lot of money out that front door that you may not have to. When it comes to legal advice, I used to actually network with this one lawyer 22 years ago. Him and I and a real estate agent, we all got together and we formed our own networking group because we were brand new in the business, wanting to help each other out. I can tell you that his britches have gotten so big since then that I wouldn't dare send anybody to him because he is now too big for himself. So with that, I don't want to go and hurt too much more. How might professionals help? They protect your family and farmer against divorce and creditors, fair and equal distribution, funding a tax bill when it's needed, help funding a sale or retirement, making sure you're aware of all the legal issues, and arming you with tax knowledge. Okay, guess what? I'm gonna shut up.
Now we can retire. This is awesome, Minetta. Thank you so much. I know that in working with succession planning with some of the clients that come see me at the Regional Business Support Network, just planning for that getting ready period for assessing the value of your business, assessing the value of your equipment, making sure you have your standard operating procedures in line. So when you're selling it, it's turnkey for the buyer. That also adds a lot of value to your business. So for those of you who are live, thank you so much for joining us with this episode. The Regional Business Support Network comes to you in collaboration with Community Futures Central Alberta and the Town of Olds and Invest Olds, funded in part by Prairie's Economic Development Canada. So we're excited to be here. And I always say our services for you are at no cost to you. We're the good four-letter F word. We're free. So our support services, our advisory services, our promotional services come to you and the community and the region at no cost. So if you would like to sit down with me, your business development advisor, you can absolutely shoot me an email at mmcfadden@rbsn.ca. I'll put it in my email as well when I send out the recording. And absolutely reach out to Minetta to do your personal succession plan. And those services are absolutely incredible, especially the connections that she has to our friendly business brokers. Minetta, just one final thought.
Yes, what I wanted to point out that I didn't point out in my session there is it's never too early and it's never too late to start this. I've had people say to me, "Oh my God, I'm 69, I'm 71, I can't do this. What can I do now?" There's ways. There's total ways. And then we also have people who are asset rich, cash poor. There's also ways of fixing things for that. So that's all I was going to say with that.
Awesome. Thanks, Minetta. I know that we've run a little bit over time, but does anyone have any questions that we could answer before we sign off today? If you do, just unmute your mic and ask away. No, it's really either really clear or it's clear as mud, Minetta. We never really know.
I told them I'm very smart. That's what it's all about. It's all about my smartness.
Minetta, thank you so much for sharing your wisdom today. As I said, the Regional Business Support Network has our Biz Bite episodes once a month. Our next episode is what is happening with social media in 2025. Because what used to work 3 years ago no longer works anymore. So what works and what doesn't? We have a great panel of experts joining us to share more thoughts on how to use social media for your business, the new rules and regulations around using social media. So check your email from the recording. I'll have the link to the registration. And again, no cost to you, these great experts coming into your business to help. So thank you so much for joining us. Minetta, you're a world of wisdom. I will absolutely put Minetta's information, contact information in the email that I send you with the recording. Please reach out to her. It's worth a conversation. And you know what? She's just a great entertaining human. So why not spend a few minutes with her? Anyway, with that said, thank you so much for joining us. Really, really appreciate it. And bye for now.